Welcome to today's webinar, compiled and produced by the team at BizNews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the BizNews.com channel on YouTube. Well, indeed, it will be. I'm Alec Hogg here from the BizNews studio in Sandton. Lovely to be with you this Wednesday. And we've had quite a busy week of webinars already. But this one is probably the most appropriate right now, given the strength of the Rand. There's Martin Freeman, who's joining us from New York. What time in the morning is it there, Martin?
It's just gone 5 o'clock in the morning.
5 a.m. My goodness. Thank you once again for getting up as early as you do. Do you normally rise at 4 a.m., that kind of time?
Not on most mornings.
Okay, well, we got you today, though. And also is your local colleague, Justin Clarke. Let's get Justin's camera on as well. Stuart, if you could help us to do that, make sure that we can get Justin on the picture as well.
Thanks, Alec. Justin, I've just sent you a webcam request. Sorry, I can deactivate, I can't activate. If you can just open your webcam again, sorry.
Okay, well, there we go.
Glad that you guys brought me into the discussion today. Thank you, Stuart.
And we can see you aren't in New York, Justin. You based here?
Sunny, bright day today. So yeah, not like Martin in the darkness. I think during the course of the interview, we see the sun coming up behind him, which is quite nice.
We've been partners for quite some time now. It's been wonderful to watch the progress of OrbVest, and particularly because of the way that the investors in the BizNews community have been investing pretty much at the right time. When the Rand has been really strong, they have had an opportunity to see the benefits of both the Rand weakness, as it tends to do from time to time, and the return on their investments. But today we're going to talk about number 30. It's quite incredible. So you've now had 30 of these projects. I put together a little slide presentation. We'll talk about you guys in just a moment. But that slide on the screen kind of tells it all, doesn't it, Martin? Maybe you want to talk to that. That's the Rand dollar in 2 months, just 2 months, from over 17 Rand for $1 to now under 15.50.
Well, Alec, I think that it tells a part of the story, which certainly is, the emerging market story. We deal with many countries around the world now, and you've seen a similar trajectory in many of those countries. And I don't think it's the fact that the Rand got stronger. As we know, the fundamentals in South Africa, I think, are certainly compromised at the moment. I think it's dollar weakness to a large degree, and concerns around COVID, concerns around the US election and the economy in the US. However, as we've seen, if you look at a graph over 5 or 10 years, there is a consistent depreciation in the Rand, especially given the interest rate differentials. So certainly it's a good time for people to climb in. We've seen this continual up and down spark, and those of our investors that have invested when the Rand strengthened, and then all of a sudden it weakens again, see even greater returns.
Before we get into the questions, and I'm sure there are going to be lots from community members and from the attendees of this webinar, which we are doing live. Of course, there's always a recording, which is going to be posted a little later. My colleague, Stuart Lohman, has got the technical details. Stu, do you want to just make sure that everyone can hear us and indeed how they can participate?
Excellent, thanks, Alec. Welcome, Justin and Martin. Just quickly, those new to the webinar, there's a little control panel on the right-hand side. There's a little high five button there. If you can hear my voice and see Martin and Justin and a nice Rand graph underneath, can you just give us a high five? There we go. Alec got some high five, so that's always good to see. As Alec mentioned, we do look for questions for the webinar itself. There is little questions dropped on that same control panel. If you put them in there, Alec can pass them on to Justin and Martin as they come through. But all good this side technically, Alec.
Brilliant. Okay, so let's get to the reason why you've gone into Phoenix, Arizona. Martin, you are based in New York, and OrbVest has been going. In fact, I want to put another graph up here to start with. Please talk to this graph, because we have spoken over the months, over the past couple of years, about your strategy of becoming a substantial fund in the United States. And this graph, which I took from one of your presentations, shows that you now are at over $300 million in real estate in your fund, and you are looking to go much bigger into the future.
Absolutely. So, we set ourselves a goal that by 2023, we would be in 10 countries in terms of raising equity. We're very proud of the fact that as a global real estate player based out of the US now, we are well over 10 countries already, which we're tracking well ahead of our goal of 2025 being a listed player on the NASDAQ. And in terms of even the portfolio, we really are seeing a strong performance. And I don't think it's because it's also just OrbVest. I think it's also because of the fact that the world outside of America is looking for just good, consistent dividends. And I think everybody's looking for that in terms of diversification of their wealth. And we offer a great solution, I believe.
Justin, from the South African angle, are you finding that the story is being better appreciated now, i.e. it isn't just a bunch of guys who have gone over, found their own investments, and then are welcoming others to co-invest with them, which is quite well known, but that it's a substantial operation. $308 million is like 5 billion rand. That's a sizable amount of money to have been invested in the USA already.
Absolutely, Alec. I think that if you remember that the way we started off, it was effectively our co-founder and chairman, Henny Bezuidenhout, who involved a few of his high net worth individuals, and they went out and bought the first couple of buildings 7 odd years ago. And eventually that's turned into a situation where when we first met, I think we were talking about 1,000 odd investors, predominantly from South Africa at that point. And I think that where we are now, I just noticed that we sent out a newsletter to our investors the other day, and it was well over 4,000 investors. And if you think about this year, where the majority of the growth has come from, with COVID, we had China and Brazil that were two very, very strong countries previously. They were very subdued over the COVID period. And so most of the growth has come from South Africa, yes. So absolutely, if you think of that 5 billion odd rands that has been invested, I would say that 4 billion is probably still from South Africans.
Just a small thing. I don't know where the notifications are coming from, but when you hear the noise of the notification on your computer, it comes through to the rest of us, and it can be a bit distracting. So if you're able to just still down those notifications on your computer, please. Right. Martin, from your perspective, why are you, as the CEO and founder and co-founder of OrbVest, sitting in the United States?
Well, my journey itself really started many years ago when I wanted to invest personally, like all your listeners, into something that I felt was a little bit more consistent. I was a person sitting in South Africa, investing through the various structures that everybody else does in the various companies. And every year my returns were up, they were down. There was an excuse every year. It was first Greece, then it was China, then there was always an excuse. And so I heard about real estate overseas. Clearly, if you go to Australia, you might get the capital appreciation over time, but your cash on cash is terrible. Similar stories elsewhere in the world. And I just found that the US had everything lined up. And so I had my first investment. I was told I was going to get between 8 and 10%. I'm talking back in 2012, 2013. And I was very skeptical. And eventually, when I received it consistently every quarter, I really realized that there was this amazing opportunity. And so as I moved further down the line, it just gathered more and more momentum. I met my partners, And ultimately, as a strategy, I believe to build a big business, you have to be single focused and you have to position yourself as a player. And I believe that that means being a global player based out of the US, so that people feel comfortable, especially South Africans. We have a team here, and it's going to continue to expand, of South Africans on the ground, looking after people's money and being the custodian of people's money. That's the difference. We're not just handing it over to some other person in America and hoping it's for the best. It's us.
Well, so much for the background, and thanks, gents, for sharing that. And perhaps what you haven't covered is that all the co-founders are entrepreneurs who are very successful in their own rights, and so you co-investing alongside Martin, Justin, Henny Bezuidenhout, etc. Let's get into the latest story, which is, or the number 30. So it's the 30th building, I presume, because it's called number 30. And you've gone here for Phoenix, Arizona. I think 29 is also Phoenix. Is that right, Justin? So these are, you have two now in the same state, in Arizona.
Absolutely. And I think, Alec, that, you know, we talk about diversification a lot. We are in very strongly in Georgia, very strongly in Texas. We are starting to build a nice portfolio. We always do a couple of buildings in one state before we move on, in New Jersey, and now our focus is absolutely on Phoenix. Reason, obviously, fourth biggest city, growing like the clappers, should be the fourth biggest city before the end of the decade. We love that sort of fundamental.
Martin, from your side, it's a long way away though, isn't it? Phoenix from New York?
It's a fair distance away, but I think that, you know, people often forget that the United States itself is 50 countries. And so everything is far. But remember that we actually have a team that not only travels to all our buildings throughout America, and we have an office in Atlanta also, but we will continue to focus on predominantly the mid to the southeast of the country. And really, we're not going to be going to many states at this point, unless a real opportunity presents itself. We're going to stick to our 4 or 5 key states where we believe that it aligns well to our investment committee criteria.
All right, so let's go into the Phoenix market. And here's another graph that I pulled from one of your presentations, which talks to rental growth. Perhaps you'd like to just unpack this for us.
Great. I think if you have a look at 1Q 2019, you look at the yellow bars there. It's quite incredible if you look at the growth in the net rental that an average building will achieve in the Phoenix metro. And what is fascinating there, Alec, is have a look at COVID, 2Q 2020. Almost no change. In fact, there was an increment of 1.75% in the rentals of new leases that were signed during that period, 2Q 2020. I mean, isn't that phenomenal if you consider what was happening in the US at the time? I think that's a fascinating graph, and you know, this information is not, it comes from Revista, and it is you know, really interesting. We always make sure that when we acquire a building, we do not pay substantially above what the market rate is, because that means that at the end of the rental period, you're going to have a correction. And when you sell the building on, the buyer of that building ultimately is going to discount the price paid because your rental is too high relative to market. The other thing to be concerned about is if the rental is considerably below market, you need to ask yourself the question, what's wrong with this building and why were leases signed at the time at such a substantial discount? So you'll notice that this particular building is around $20 odd per square foot net, and the market is sitting at around $20 per square foot net. Spot on.
Let's just go a little further into the building itself now. Tel Aviv Spectrum. Interesting name.
Yes, Martin, you had some good thoughts on the name, and you'll notice that there's a few Tel Avivs in the area, and I think it's got some Jewish heritage.
Yeah, and I think that when we purchased the building, immediately, you know, where you'll see the tenants now, I think it's common practice that sometimes people name a building after their children, and so I have a strong perspective that someone probably had 2 kids called Tal and Avi, so it's actually called Tel Aviv.
Tel Aviv. Okay, not Italian, as it might appear on first. How do you get a building like this coming onto your radar?
So I can answer that one. So after Medical 29, one of the things that we do is we spend a lot of time going through to the building to do our due diligence, to interview people around, to look at prospective property management people that can assist us with leasing up, etc. And again, just right place, right time. My acquisition manager in the US, Andrew Fotis, who's got 30 years experience, was physically in the area talking to a broker, and we were talking about what exactly we do and how we expand our network across America, and we're very selective as to who we do business with. And the person actually said, you know, there's a building that may potentially be coming on the market. It's an off-market deal, and that's obviously our first prize. We want off-market deals. And he made a few phone calls, and the person said, yeah, they were about to list it in 2 weeks' time. Andrew went immediately and had a look at the building. He phoned us from the building and he said, guys, I've got a great one. Sweet spot deal, as we called it, meaning in terms of our price range, returns, etc. And he said, we can get this before it even lists. And so that's exactly what transpired. Right place, right time.
And it's lovely. These couple of pictures there of the building or inside the building, it looks to be very high quality finishes.
It's totally A grade, Alec, and it's refreshing when we get to a building and there's no evidence of any real repairs and maintenance or restoration that needs to happen. Obviously, we do get independent assessment before we close on the deal, but we don't expect there to be anything to be done to this building. It has been magnificently maintained.
Here are the key facts and figures, again, from your presentation. Do you want to take us through that? Because I'm sure that investors really want to get into the nitty-gritty and know what it is that they're investing in, given the way that OrbVest structures things is that you like to get diversification over many buildings, and this one in particular, let's talk it through. Start off with location, Martin.
So we've spoken about location in terms of Arizona and particularly Phoenix. And as everyone knows, who's been listening to the ObVest story for a while, you know, our predominance has been in Texas, New Jersey, Atlanta, Georgia, and we have been targeting Arizona for a long period of time. It's such a great place in terms of, at the moment in the US, attracting individuals from the north to the south, the warmer weather, the low taxation rates, and also being very affordable. So that's the reason why it's experiencing an absolute consistent growth rate in terms of the population. And as we know, when your population grows, all the various associated assets around it grow also over time. We don't bank on that. However, it is a good underlying support mechanism.
Justin, do you want to talk to the second point of it being in the medical field, which is where you guys are highly focused?
I think most of your listeners on the call will probably know that we are hyper-focused. We believe that the only way that we'll become an expert on medical real estate in the USA is if we only do medical. And even the medical, we concentrate on certain categories of medical. We like a diversified medical office building with multiple tenants, or alternatively, if it's a single tenant, then it's got to be a AAA tenant that's sitting behind the lease. But what's beautiful about this one is there's a lot of value add. I'm going to talk a little bit to that, Alec, if you can go with me on it. It is predominantly not a medical building at this stage, but it's in this amazing area. They call it the Arrowhead Crossing. And on your previous image, you saw there was, in the distance of the image, you saw two yellow lines crossing. They call that the Arrowhead Crossing. And this is an area called, you see the yellow lines there. This is an area that they call Glendale, and Glendale is growing faster than the average of the area of Phoenix. And it's very well known for military. It's got the Luke Air Force Base in Glendale. Healthcare, Banner Thunderberg, I'm open to correction, but I think they have 6,000 employees in the hospital system that they have that's within 1.6 kilometers or miles of the building. And then, of course, education is phenomenal. You can just see Midwestern University on the right there. There's a little black banner there. The others are cut off, but I'll read them to you. It's Arizona State University, Midwestern University, and Arizona, all within a 2-mile radius of the building. So it's a really, really pumping area, and that's what we like about it. Across the road from Walmart, as you know, Walmart doesn't go anywhere where there's an enormous amount of foot traffic going through. And then coming back to the building and the value add. This building is at the moment not medical 100%, but the value add is that a medical building is considerably more valuable than an average office building for lots of reasons that many of your listeners will know. Office is under pressure, and medical is increasing in demand for various other reasons, the fundamentals behind medical. But since we have bought this building, Alec, and this is why we are benefiting from being specialists in this space, we've already filled one of the spaces, 4,500 square foot, with a medical tenant for 5 years, roughly 6% of the building. So we are well on our way to converting it to a medical building, which is a value add. Filling empty space, as you know, value add. Finally, to talk about the 2 tenants in the building, both of them are high credit tenants. The first is a Jewish children's pediatric type facility, and the other one is a insurance company. Now, the insurance company we never intend to try and replace. They are a high credit tenant, and we will leave them in place in the building. And obviously, the intention is to re-sign them at the end of their lease in 5.5 years. The Jewish children's practice is on a 12.5-year lease, which is fantastic. They're a not-for-profit, highly well-funded, and so you've got guaranteed rental covering half of, or basically covering your senior debt. The rest of it is just value add. I think
Justin, I pulled a pie chart out from your documentation, and the blue there at 35.7%, that's the insurance company, and then the orange is the Jewish Family and Children's Service, and then there's 9%, which is the next biggest one, which is Q Financials, on Q Financials. So the gray next to the blue on the top there, top left, that's 11.8%. That was the vacancies. Are you saying that that is now reduced since the purchase?
Exactly. So we're well on our way to filling up that vacant space. As I say, 6%. So what is that? 11. So, you know, more than half of that is already accounted for on a long lease from a medical tenant. So this is how we add value to these buildings. Repurposing the building from office to medical is massive.
And the yellow one there is Getix Health, which presumably is in the medical field already. So you would be wanting to do that when other, or these smaller lessees, when they expire or their leases expire, would you want to then convert them over to medical?
And that is the strategy, yeah. So as soon as the lease comes up, we try and bump the tenant out and replace them with a medical tenant. And that's you know, that's where the expertise comes in.
Just to again give us a better feel, Federated Mutual Insurance, that's the biggest tenant here, 35, call it 36%. How big are they? How secure are they as a business?
No, they are obviously massive. I think that their net profit for the last year was in excess of $222 odd million. So, you know, I think they're a fairly substantial tenant. They have been in there for, I think, since the building, since 2002, if I'm not open to correction there. So absolutely solid, and we wouldn't want to get rid of them. They're a value add in terms of being such a high credit tenant, and it makes it very attractive for anyone acquiring the building when we get to sell at the end of our period.
So that's still the strategy, Martin, that you'll hold the building for a period of time, add value, get dividends to investors, and then sell it.
Yes, that is absolutely correct. One of the things that we always target is around 8% cash on cash, and that's the starting point. And so I think bringing this all together is that we've spoken at length on the webinars about why healthcare and why medical and why it's so stable. And, you know, yes, there are other asset classes. In our opinion, there's so many variables in that, the what ifs, what am I going to sell it for, what am I going to refurbish it for, what are the rentals I'm going to get. In the medical office building or building like this, you really have your 8 or 12 tenants. They are triple net leases, meaning they pay for all the expenses in the building, which means that you've got a consistent cash flow coming in. The building is then able to generate its returns of 8% cash dividends per annum, which are paid out on each quarter. And then at the very end of the 5 years, we then sell the building together with the capital gain, which generates a double-digit return in dollars. And that's what we believe not only South Africans, but people in most countries outside of America are seeking. And certainly they love these kind of propositions.
Let's get to the questions now. And just to remind you, as Stuart said at the beginning of the webinar, there's a little question mark on your control panel. Just click that and you can type your questions in. Sajid, and by the way, I will not give your surname, so you can happily be anonymous. Your first name, of course, we have to give so that you can identify with what the question is. But Sajid asks, he says, won't Medical 30, this building, compete with Medical 29 since they're both in the same city? I recall that Medical 29 already had some degree of vacancies at the last webinar. Gents?
Yeah, if I can just come in over here, each tenant has their own opinion, and we have different people bringing tenants to us all the time. So remember that now this building literally has almost no space left. So over time, when we find tenants, it is very dependent on the tenant, where they want to move to, which building, what they want to pay, what their practice does, where their clientele are. And so we have seen no scenario of tenants competing over various buildings. I think that also we've got to understand that these buildings are enormous. They really are. They are significant populations with just thousands of tenants, and I don't see any scenario where there's any kind of competition or concern around that. As long as the buildings are able to be leased up, and as long as the buildings are able to generate their returns, I think that's what investors are most concerned about.
Andile wants to know. Please carry on,
sorry.
Justin.
Cutting you off there, Alec. Perhaps another way to think about it is, if you have a medical practice and you want to open your practice in Stanton, you're not going to take premises in mainland Pretoria, and that's the size of Phoenix. It's a massive city. First thing. Second thing, of course, when we speak to brokers, they get very enthusiastic because we have a range of different types of medical doctors that we're looking for. So we say we're looking for a surgery center for this building, we're looking for a radiology center for this building, etc., etc. And they've got a very strong mandate to go and approach doctors and put their time into it because we've got a number of spaces that we can put them into. So 2 answers to your question, Sajid. Thanks.
Stunning. Andile asks a question which is related to the bottom area there, which talks about returns. He says, please explain the difference between cash on cash and the IRR. And you've got the quarterly dividends of 8%, 14% IRR. What is the difference? And when you come in as an investor, which is the number you should be watching?
That's a great question. And so I just want to explain that. The first thing on this building is I just want to also mention that we have launched 2 different categories. And the first is the normal category for all the standard investors around the world. And then we also have what's known as a corporate category. And this is for any investor who puts in $500,000. They get slightly enhanced returns, obviously because they've invested a lot more. So to answer the question directly, when you buy any kind of building, you get 2 kinds of things happening. Number one, it generates quarterly cash dividends. It makes a profit every month, and at the end of the quarter, you pay out that profit, just like you would if you bought a building in South Africa. Then at the end of 5 years, you sell that building. People often think that if the building has gone up by 50%, it means you buy a building for 10 million and it goes up to 15 million. And I like to explain this equation, if you'll just indulge me for a second, Alec. And that is the fact that when you buy a building, I'm just using an example, $10 million, and you have a mortgage of 7 and you invest $3 million equity. After 5 years, that building has gone up, but just a few percent every year, call it 4%, and it's gone up, and now you sell that building for 11.5. You've made $1.5 million, You only put $3 million in, which means you made a 50% return on your money in terms of profit. Those two numbers together are called your internal rate of return. It's basically a financial calculation that says your profit and all the returns you got together, what is that over the 5 years? So in fact, investors, that's why I talk about double-digit returns. It's a fantastic return in dollars of potentially 11, 12, 13, 14% total returns over 5 years per annum. It's the reason why people invest with us consistently all the time and have done so for now going on 7 years.
Are property prices in the United States stable or rising? In other words, that internal rate of return, can that ever go below 8%, which you're getting as your dividend? Presumably, if you had a building that you sold in 5, 6, 7 years' time at less than you bought it for, is that feasible in any way?
I think any investment always carries risk, and I want to be very clear on that. In that, whatever you invest into, whether it's the stock market, whether it's a building in South Africa or anywhere else, if you lose all your tenants or something changes dramatically, you can end up being in a not so great investment. However, the reason that people invest in the United States, and we do, is because it's very stable. Having said all of that, you know, the one thing is you're investing into bricks and mortar. You're becoming an owner of real estate in America, and you would hope and expect that the current trajectory of what's happened for the past 20, 30 years, a decent building in a good location should be worth, with the right tenants and escalations in, a little bit more than it is today. What's the worst downside that could happen? You sell the building for 90% or exactly the same as what you bought it for. The one thing about healthcare cap rates is what you're buying the building for, is they have remained so consistent for such a long period of time. In fact, at the moment now, they are actually going down, which means the buildings are becoming a little bit more expensive, which means our current portfolio, when we sell it, we believe in 5 years' time, healthcare will be worth more in the future than it is today because it's proven its resilience.
We got a lot of questions to get through today, but there are 4 of them from Denise. So I'm gonna shoot them one at a time at you. Her interest here is in Phoenix itself. What drives demand for medical properties in Phoenix? And then she says in the US in general.
I'll take this one, Martin. So I think there's some very interesting trends. Is it Denise? Yes, I think it was Denise. Denise, first of all, there is the move from north to south. And basically what happens is when people get towards the end of their working life, they tend to move towards a warmer climate. And you've always heard about Florida being the retirement state. Well, it's not only the retirement state, so is Texas, and so is Phoenix, Arizona, or Arizona as a whole. So you've got migration of retiring people moving towards the warmer cities. There's a second thing, and that is state taxes. Some of the taxes, like where Martin lives, there's quite high state taxes. So if you are living on a fixed income at the end of your life, you want to move to a place where you're paying less tax. And that's why you tend to target places like Arizona, Texas, etc. So those are 2 of the fundamentals. Then, of course, what happens when you get older? You need more medical assistance. And you know, the number that we normally quote, and it comes from the data that we get, is that the demographic over 65 uses 5 times more, or spends 5.5 times more on medical than the demographic below. And I think, you know, that's evident if you look at your parents or anyone older in your community. So, you know, those are the things that drive us. You've got this growing population to start off with. Then you've got a growing population of older people, and then you've got on top of that, you've got a you know, this very interesting trend that more people are getting older. And then I'm going to throw a final one in here, and you don't give me the mic, Alec, but that is that, of course, there is a movement slightly away from the hospital systems, and that is because of technology. So there's a movement out of hospitals into our type of medical office buildings. The reason is, if you now go for a procedure, there's a very good chance that the doctor has his own little surgery center, as we call them, within his consulting rooms, and he will be able to do that procedure now because of the technology that is now advanced. People are spending less time in hospital and more time in these, in South Africa, we call them step-down facilities.
Denise's second question, I think you've already answered. Would you describe Phoenix as a retirement location? Hence, there's demand for these kinds of health facilities. Moving on to the third one, over a 5-year period, what has been the Phoenix commercial property market? What has the Phoenix commercial property market been like, particularly medical real estate?
Well, I can jump in here and tell you that over 5 years, it's been incredibly buoyant. It's shown significant growth. There are a lot of people competing for assets down there. Hence, the ones that come online, meaning via the brokers published across the whole of America, they snapped up very quickly. And that's not what OrbVest does. You know, we like to find off-market opportunities. We don't like to compete because otherwise you're going to overpay. And so if you can, in real estate, buy at the right price, which means an off-market deal that you're not competing against 10 other companies for it, that's always first price. So as I said, we've been trying to get into Arizona for a long time now. It's been very challenging and competitive, and our 2 assets now we're very proud of. I think they're going to yield fantastic returns for our investors.
And in addition to that, Mark, like your previous graph where you covered the rate per square foot, I think that absolutely demonstrates it, because it has been increasing even through COVID, quarter on quarter, and that's pushed by demand.
Okay, let's just put that graph up again just to remind us all of it. Apologies, this is a different, this is a purchase price.
That's the selling price of the property, and I can't tell you what happened between 3Q 2019 and 4Q 2019, but clearly you can see the trajectory is back up again. And then if you look at the previous one, that was the rate per square foot in terms of rental, and that's ultimately what powers supply.
Here we go. Got it at last.
Absolutely. Okay. Look at that. From 1Q 2019, rent was at $19, and it just continues to go up even through COVID up to $20. And that is ultimately what powers the value of buildings that are sold, because if you're getting high rentals, then that translates into the value of the building directly.
It's so interesting talking to you guys about property, because there really are some fairly easily to understand processes that are going into these investments. And there are a lot more questions coming through, but the final one from Denise, and then I think we will have given her more than enough time, is for South Africans investing in this opportunity, what sort of yields can they expect? Are these the norm in the current market?
I think that these particular deals are generating yields that are aligned to our goals. However, I will say to people the following, that it's becoming more competitive in healthcare. And do I go into 2021 thinking I'm going to get 8% returns on all our buildings going forward? Maybe not. That depends. I'm not sure what people are going to sell their buildings for. But I can tell you, because COVID has proven how resilient healthcare is, there are a lot more people in this space looking at buildings. And when I speak to people in America, the smart money is moving towards healthcare and healthcare assets. So I can say to everyone that, the area is getting more competitive. The niche is certainly attracting more players. But does it really make a difference for international investors? And I speak about Martin and my family and my friends. Whether you're getting 7.5 or upper 7 or 8, and you're earning double-digit return in dollars, and for all our investors worldwide, that's what they want. And so I'm more concerned about, is it a good medical office building? Has it got good tenants? And are we going to be able to get those good returns going forward, whilst the rest of the world in the equities market bounces up and down and you never know where you stand?
I guess the other thing is, as you get greater demand for the properties, then your end selling price would presumably also be more attractive. Daphne, she's been waiting a long time. She says, I'm a South African living permanently in the UK. What are the tax implications of having this investment in the United States? Would there be a tax liability in America?
Can I firstly answer this and say that one of the things I enjoy most about OrbVest is what we keep finding is our ability to attract people around the world. And, recently, we were looking at our country list again. It's not heavily publicized. We've got people now in Kenya, Uganda, United Arab Emirates, Saudi. It's just amazing. And So to Daphne, the way that it works is that the money is moved via our international listing structure, and that international listing structure is for all our people outside of the US. Money gets aggregated in there, and then what happens, it gets invested directly into the United States, and it goes in and it comes back out as distribution and dividends. So all the taxes are paid in America. Our investors aren't part of it. You're not part of all the legislation and compliance there. We take care of that. And then what happens is when you receive the dividends or distributions in your country, you then declare it as you would any distribution or dividend on any share in the world, and you pay your appropriate dividend tax or capital gains tax, which, as we know, is quite small.
It's quite a simple process then for investors.
Well, cross-border is not necessarily, you know, as easy as doing a local investment here in South Africa. When you're dealing in single currency within the same border, there's a bit of a KYC process, which I think most people that have invested offshore are familiar with. But, you know, we help with all of that. And, you know, perhaps, Alec, one of the things that's always missing is that one of our people mentioned the other day that one of their clients is very surprised that we had anyone in South Africa. And in fact, we have significant infrastructure in South Africa. We are a registered financial service provider in South Africa. So we can help you with you know, if you're in South Africa, we can actually talk to you and help you, and you can meet your warm body. In the UK, I'm afraid, Daphne, I'm afraid not just yet, but certainly, you know, we can talk to you directly and see if we can answer your questions better.
And regarding, you know, people in the UK, you know, we have other clients in the UK. And the one thing that I want to encourage all the listeners from around the world on your show today, Alex, is that, you know, we have these investors from around the world, and they are so surprised when they actually go down the road. We can literally, within a couple of days, have them invested in real estate. And then they're even more surprised. What happens is when they get these consistent returns. And that's the reason why our investment rate is actually so consistent and high, because people just want to then do one building after another and build themselves a little mini real estate portfolio in the United States.
Cheryl asks, how and how much can we invest?
So Cheryl, we have made it possible to invest from a very low amount, $5,000 odd. And on the other side, you know, we have a cornerstone club of very, very high net worth individuals, family offices. And if you are talking about that end of the market, then we offer special packages where we give you a slightly higher, if I can say, RR at the end of the day. So if you are in the top end of the market, we'll certainly talk to you about becoming a cornerstone club investor, and then we don't mind how many millions of dollars you wish to put into these buildings, but we do tailor it that specifically. But other side, 5,000 into your first building, and then from then on, whatever your dividend is, you can reinvest.
Steve's question is this a 5-year or 7-year investment?
Super question. Thank you very much. When we first put this on the market, Steve, we assumed that we would have the insurance company, which lease comes up in 5.5 years' time. The value add would be if we re-sign that company, and we allowed 7 years in the assumption that what if we didn't re-sign that company, we might need some time to replace them with a medical tenant. I think that's, we don't believe that probability is more than 5 to 10%. So I don't think that's likely to happen. That means that before the 5.5 year period would happen, we would have already concluded a renewal of that lease, and we would be able to put the building on the market immediately after that. So we've changed it now from a 7 to a 5+1. In other words, it's 5 years, but we believe it'll run over 5 years in order for us to finish, to conclude the lease, and then find a suitable buyer for it.
Alec, if I can just come in here and say that one of the things that OrbVest does is we have a very close relationship with our clients and our investors, and we like to listen to them. And so up until now, we've always had typically a 5-year and a 10-year option, and that's our buildings, because real estate is a long-term investment. But if you're getting these kind of dividends, you don't mind it being long-term if you know where you stand. And so immediately when we launched it, we got feedback with people saying, can't you just have your normal standard offering? And so we did. We changed it, and we changed it to the 5+1. So it's in that same 5 to 5.5, 6 year bracket. And so I think already we've seen a surge in the equity that's being raised now into this building in the last 48 hours.
Martin, there are a couple of questions here about the minimum, that $5,000 that Justin mentioned. How did you get to that number, and what exactly does it mean? Are there other fees on top of it, or was it just straight $5,000 in UN?
So what happened was originally, you know, the thinking was $50,000 to $100,000. And for anybody that knows both Justin and myself, we really love to build very big scalable businesses. And we like to say to people that our legacy is that we're going to help thousands of investors around the world and their families in terms of being able to participate. And so we wanted to lower the barrier. We're not prepared to go down to the very lowest level because that requires tens of thousands of investors and very big systems. And, you know, it really becomes a difficult business to manage. There are very good people that manage those bottom scenarios. And in fact, watch the space. We might have some interesting announcements in the next couple of months to cater for everyone across the spectrum. However, at this stage, what we did was we always felt 5,000 was reasonable. It was 75,000 Rand. It meant everybody could potentially get into a building. And so over time, we reduced it down to 5,000. I don't see us going below $5,000 unless something happens with the Rand. It's interesting to note that in other countries, for example, our averages are close to either $50,000 or $100,000. In South Africa, we obviously have a weaker currency, so it's lower.
Lynn, who I know, I'm not going to say your surname, but I know she is a chartered accountant and has got lots of people she advises. She says, I see on the webpage that you expect to keep this one for 7 years, normally 5 years. I think we have discussed that, but perhaps you'd like to just explain the reason for the change again.
Absolutely. You know, once again, one of the main tenants that we value is an insurance company, high credit tenant. Their lease is 5.5 years. We anticipated that we would allow 5.5 years. If that lease did not renew, we would take an additional period to renew the lease before we were able to sell it. So we said, let's make it 7 years. We did come across some feedback from some of the investors saying 7 years. They preferred to be the 5 year, the standard 5 year. We said, well, fine, it still works for 5 years, so we change it. It's now 5 years, but we are saying it'll be another 1 year to make sure that we can re-sign that lease, extend it for an additional period. And of course, that's why we changed it from 7 to 5+1.
I think the other thing I just want to mention is people often ask, is it always cast in stone for 5 years? And the answer is, it is a plan. But remember, as investors, we all want to be able to maximize our returns. So, you know, if you were ever going to sell a building in the middle of COVID, you would delay it by a couple of months. And then conversely, if you ever got a fantastic offer, you would look to accelerate and sell it sooner, as long as at all times the decision is on behalf of the investors. They get to decide. We put it to a vote to all the investors, and obviously if they decide to go along with the investment committee, that's great. And then the other part of the equation is, if we can sell it and deploy your profit and your capital into a similar great building, then that's great. The reason why I mention that is, in fact, over the last 72 hours, we received an offer from one of the big REITs in America to potentially acquire one of our buildings just out of the blue. And so, like, that's a scenario we're going to look at. And obviously, if it's a great price, obviously everyone's got a price and we want to sell and make a profit.
So it could be below 5 years if that were to happen in certain instances.
Absolutely, because then what happens is, because you're selling over a shorter time frame, your 14% IRR will increase dramatically up to 16, 17%. And so that's always the nice to have, but we don't. We like to plan for consistency. It's a 5 plus a, call it 6 month or a year scenario. And that's what people must know when they go into it, and be prepared to just be in for that period of time and build their wealth consistently over time.
Just to elaborate very briefly on this, Robin says, what happens to the funds that are aimed at a 7-year period?
There's no funds for a 7-year. Remember, forget any notion of 7. It was originally 7. Remember, when you buy a building, even if you did in Joburg, you can look at the numbers and say, okay, so what happens if I sell it over 3 or 5 or 7 or 10? So we did it initially, as I said, over 7. We remodeled the numbers, and the numbers are the same. get hold of OrbVest. We'll give you the latest brochure. It's not a material change at all. It's a minor change. The cash on cash stays practically the same. And so for everybody listening today, it's a normal standard OrbVest deal. And that is what we've aligned it back to.
Costa's probably been following another one of our business partners, Bright Light Solar, because he says, I see the roof does not have solar panels installed on it. Have you explored the feasibility of installing solar panels on all your buildings as added value or extra value add?
I absolutely am. And going forward, I think everyone in the United States is going to be looking at that closely, specifically as your solar pricing drops and your return on that investment for each individual building increases.
But I think to add to that, Alec, I mean, your electricity bill, that part of your utility is actually very low in the US. And Martin, share perhaps what you are paying for utilities. I mean, we are getting left behind. We used to have super cheap electricity, but it's now super expensive.
Yeah, in the US, really, it's not a big thing to talk about in terms of electricity. I think that when you have a country that actually works well and delivers what they say they're going to deliver, when you pay your taxes, I think you can at least feel very proud of that.
It's also about competition, isn't it? If you have a sole supplier, you're on a hiding to nothing, as we have just seen. Costa's follow-up question, he says at number 30, has MED 30, has an extensive assessment been done on all the aircon units to ensure that they're in good condition and were serviced properly over the years?
So Costa, the one thing that you'll know in real estate is the very first thing the investment committee does is we want an HVAC report. So in America, specifically where I am, everything is ducted, which means you don't have an air conditioning unit on the side of your wall. Everything is ducted by an enormous unit outside your house that keeps your entire building or house at the same consistent temperature. Hence, people don't really feel the cold in North America. So one of the expenses in any real estate building is the exposure to HVAC. And so it's one of the key things that we look at in the building, along with a couple of other key components. Remember, Justin and I don't simply sit down and say, let's buy a building, it looks great. Every single building we look at through the funnel then goes to the independent investment committee. We've spoken about that a lot in terms of the depth and skill of individuals on that, with guys with 30 years experience. They look at every single aspect and the risk inside out, and they have complete veto over any building. Only once it goes through that do we make an offer of intent to buy, LOI, and then we do a due diligence along the phase before we actually close it. So it's a real thorough process.
Dennis's question for you, Justin, he says, is building 29 fully funded or still available?
So some interesting developments in there in the last 48 hours, Alec. The straight answer is we've got more subscribers than we have space available, but we have had a release of some additional equity. I literally got off the phone just before this call while Martin was still asleep with Michiel, our acquisitions manager, and he says that we have some additional equity available as a result of negotiations with the senior debt provider, the bank, in other words. And the only question was whether we were going to make that 2 slots of 500 for our cornerstone investors. So to answer your question very vaguely, I'm afraid, I think there is still space as a result of this additional slot. And yeah, please just get a hold of us and let's see if we can fit you in.
Just explain that a little more, if you would. It's not an OrbVest investor who said, oh, I don't want it anymore. It's somewhere else that the equity came from.
So Justin, maybe if I can jump in here. So in terms of when we put out a brochure, there are a couple of moving parts. It's not material, it is a couple of moving parts. The first is that Justin has the difficult task of trying to divvy up the amount allocated of $5 million around the whole country and the world. So what happens is we've got various partners, Brazil, we've got China, we've got other countries, we've got India that's coming on stream now, and they all say, I want a piece of this. I would like to have $500,000. And so what happens is that as we go along and the list starts to grow of people that have said yes, they go through a process of they have to register on the system. They then go through obviously the anti-money laundering, KYC, FICA process, and all of that takes time. As we're moving towards the close, what happens is we always end up being oversubscribed, meaning there are more people that have said, I'm moving my money, please don't allow me to miss out on this. And then what happens is naturally somebody ends up getting left out because there's just not enough space. At the same time, the bank term sheet comes through, and for example, it might be a 60-40 debt to equity scenario, or it might be maybe a 58 or a 62 debt to equity. So that final balancing number at the end often allows, together with people in the world, a couple $100,000. But I caution everyone on this call that very often when we say there's a little bit left, we normally get a surge of interest, and then we end up disappointing people because there's not enough to go around, which is always, I suppose, a nice problem to have.
Well, the time has just flown, and we've got a lot of questions that we still need to get through if we can. So I'm going to pose them to you quickly, and maybe we can have relatively short answers. Ashley asks, why do you sell after 5 years and not hold on for longer?
Because people want to know that there's a start and an end. And people initially, new investors, would prefer probably even 3 years. What we have found is when we get to the end of 5 years, people then ask us that very question, why are you selling? Our view as OrbVest is we don't want to ever be perceived as rolling people's money. We want you to sell. We want you to experience your profit. What you do with your profit and your capital is up to you if you want to reinvest.
Simangele asks, given a low economic growth rate and low inflation, how can you rely on increasing rentals in future?
So in terms of the inflation in America, I've often said there's a perception there's no inflation. There absolutely is inflation. Whether it's food inflation across the whole of America, it exists. All our leases have between 2 to 2.5% normally in them, and your inflation is below that, which means that you're getting that differential in terms of real growth in your net operating profit.
So they're in the leases already. Ridwan's question is, must a person be invested for a fixed 5 years, or can you opt out at any time? Justin?
Yeah, absolutely. I think, Ridwan, what is interesting is that while we sell this thing as a 5-year investment, you can at any stage offer your shares to any of the other investors, and we actually do it for you. We facilitate that for you. And I must say that over our 6 years, anybody who's put their shares up for sale has managed to sell them. And it gets much more attractive, remember, for the other investors as you get closer to the end of the 5-year period, because your IRR compresses up towards the end. So you find that the longer you're in the investment, the easier it is to get out. The price that you generally get is what you put in. So you get, if you put in $100,000, you get $100,000 back. But you know, at least you got your money back, and you've had the 8% returns in the meantime.
Mike wants to ask on that subject, when do you expect to pay the first dividend on this property? Justin? So
Med 29 is closing within the next, or closing before the end of the year, let's put it that way. Med 30, we're going to miss, unfortunately, the year end, so we will definitely close it in January. That means to expand on that, as soon as we close, your money goes to work, and then the end of the following quarter, or 1 month after the end of the quarter, that's how we operate. That's when you pay the dividend, whatever pro rata portion that is.
All right, so if it closes in January, that means the following quarter would be what, March or June?
So the quarter runs Jan, Feb, March, so you'll get your rental for February and March, not paid out in May, it will be paid out in June.
Got it.
Well, in fact, Justin, sorry, just to correct you there, if we close in January, at the end of March, whatever's accrued in terms of since we took occupation of the building, you will get that in the month of, in the quarter of, or the payment in April, which is the end of the Q1 payment for the year.
Yeah, correct. Yeah.
All right. Thanks for the clarity there. Kathy asks, if one has an offshore account, is it possible to have the dividends paid into that account and thereby legally avoid paying capital gains in South Africa? Martin?
So I will say the following is any money housed around the world goes into our international structure, and we then pay back to that international structure your dividends or your returns. And so the short answer is, you don't have to have it come to South Africa. Most people in South Africa, in fact, have offshore structures. They invest directly into our various structures, and they get the money back to their offshore structures.
I'm going to try and clean up the last of the questions very quickly. Sorry, Justin, you had something to say?
No, again, just to clarify, the money actually ends up in a wallet. It's a escrow type of wallet that stays overseas. You don't have to bring back your dividends. It absolutely stays overseas. At any point, you can draw back down on that wallet and draw your money back into South Africa, but it can stay overseas.
Robin's follow-up question, he says, for interest, when did OrbVest take ownership of the facility in this discussion?
So ObVest does not take ownership of the building until obviously you have closed the building and you have paid for it. So what happens is the process in America is not too dissimilar to South Africa. You give someone a LOI, which is a letter of intent when you want to buy their building. You then negotiate and you sign what's known as a purchase and sale agreement, a PSA. That has been completed. We now have 60 days to close the building, maximum. During that time, we also complete our due diligences. And if we find anything untoward, we then walk away. The money that's in escrow gets returned to investors. So after 60 days, the money sits with lawyers. We pay across. We get the building. They get their money. It's all done via lawyers in America.
And just to
again,
confirm.
Sorry, Alec, I keep interrupting you, but there's so much to these topics. Just remember that what's changed from when we started off is we used to wait for the equity to arrive. That obviously is a problem. Now we close. So we have bridging money, and we close on the date that we are obliged to close on. In other words, the 60 days. And then, you know, if it takes a little bit longer to get the money in from investors, then that's not relevant. So I think that might answer the question.
It does indeed. Justin, the final question, and I do apologize that we haven't managed to get to all of them. When is the closing date, the actual closing date of this investment?
I'm afraid I don't have it offhand, but certainly we can give you the exact dates because those are bound by the specific contracts, the PSAs.
I would say, Alec, normally it's given 60 days from the PSA. So I would assume it's probably around 10th, 15th of January, I would assume.
This is from a potential investor. So for a potential investor, what is the closing date for them? 10, 15 January, somewhere around there.
Yeah, that's 30 and 29 is still this year, by the way. So it'll be late December, mid-December. But again, Alec, we can clarify that one-on-one if he's interested in the specific date. So we would have a specific date.
Great. And then a final question from Costa, another follow-up from him. What is the interest rate fixed at?
So the interest rate is finalized during the physical due diligence phase at the moment now. What happens then is we get term sheets from a number of banks in America. As you know, we cap the interest rate going up. It can float down, but it's capped on the upside. We don't take any chances on the interest rates in America. It's generally between 3.75 and 4.2. Pre-COVID, it was sitting at levels below 3.5%.
There's some really good questions, and I'm sorry, I am pushing it through. Simangela, you've given us 3 good questions here, so I'm going to give all 3 of them, and if you can, these are really the absolutely bloody final questions. What is the minimum guaranteed IRR? Why are you not investing in medical buildings in South Africa, replicating the model here? And then finally, have you ever walked away from a deal? So 3 goodies.
I'd like to start off with the last one. We'll always walk away from a deal because the most important thing is preservation of capital to our investors. So we have walked away from deals where we, excuse me, where we felt we weren't comfortable with the due diligence. The second thing is in terms of there is no guaranteed IRR in any investment in the world. I would always be concerned if somebody says it's guaranteed. In any investment, there is always risk, but it's a calculated risk. And I think our performance to date speaks to that. And then the third thing is, why won't I do any investments in South Africa? because I think we all understand the challenges in South Africa. I think people are wanting to get their money out of South Africa. I think South Africa also does not demonstrate the stability. And right now, with South Africa's concerns around the economy, the debt, the various other challenges that you see if you open any newspaper every day. In America, the reason why we invest here is because most states, what happened 20 years ago is still happening today and will probably happen 20 years' time. It's stable, it's consistent, and that's the reason why people love investing through OrbVest into our buildings. Thank you.
Thanks very much, Justin and Martin. There are a few other administrative questions like, can you email all the details? We will indeed do that. And for South Africans, who do we deal with? Presumably, Justin, that's you, the South African office.
Absolutely. Alec, I don't know how, if you want to get hold of somebody, we have offices in the country. If you're in Gauteng, Menlyn Main, up in Pretoria, we have a network of consultants covering most of the major cities. So if you would like to speak to somebody, please tell them that you came from BizNews. Alec always asks us, how much of our community are we is coming from BizNews, and we can't tell them. So it would certainly help to solve that problem. Please tell them if you do have a conversation, or go onto the BizNews website. There's a fantastic article that Stuart put up recently, written by our founder, Henny Bezuidenhout. And I think that's well worth a read. And click on any of those banners, and you'll be able to get through to us, and we'll jump onto you. And then, I think finally, to answer that previous question that Martin covered, Henny, our founder and the guy with all the IP into these medical buildings, is the biggest private investor in medical buildings in South Africa, to answer that question. So some of us, still invest in South Africa. It is a very challenging environment, but we feel very strongly that you should not have all your eggs in one basket. You should absolutely be diversified outside of the South African economy, because the fundamentals are not strong, and it's just very, very important that you diversify. Thanks, Alec.
Maybe we can end off and say the banner, which is something we really live by, which is live local and earn offshore.
Absolutely. Who would not want to live in this magnificent country with the sunshine and the incredible people? I think it was Bobby Godsell who said that we are blessed by our people, but cursed by our governance. And it seems to have been something in South Africa that we've had to live with. Maybe one day we'll get it right, and then OrbVest will be doing exactly what Henny Bezuidenhout does in a personal capacity, and be investing here. But it's really a focused investment into the global arena, and that's where 99.5% of the investable universe lies. You wouldn't want to invest in only 0.5% of the option, if you like. So great having you guys on again today, gents. Thank you once more for the for explaining exactly what's going on. And as Justin mentioned, there's a terrific article by Henny on the BizNews website now, which gives a little bit more background and to his own journey. And there are banners there, so you can click on those banners, and that'll take you straight to OrbVest and give you everything that you possibly need to know. Justin, Martin, great to see you again, even though it is remotely. Hopefully, it won't be too long before we can start traveling again to other parts of the world. But until the next time, the next OrbVest webinar, we wish you a very good rest of the day. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.